Number 4, earnings growth, past and future. This is the key metric which determines the price of stocks. Earning per share EPS is computed by dividing the earnings of the company by the number of shares outstanding. Earnings growth year over year YOY is important from two angles: whether earnings have grown in the past 5 years and whether actual earnings have exceeded the predicted earnings in the current year. The performance of growth companies particularly is judged by the corresponding growth of earnings. Interestingly, earnings per share is diluted by the issuance of more shares or conversion of fixed income securities into common stocks. This action would decrease the value of earnings per share. In contrast, if a company buys back its shares, the earnings per share would increase proportionately. For example, if a company abundant in cash reserves buys back half of its shares, the EPS would arithmetically double, making it more attractive to the stock investors. Remember, EPS is strongly correlated to the price of stock. Consequently, buying back stocks and assuming that the external factors do not change can eventually lead to an increase in the price of stocks. Number 5, price to earnings P by E ratio. Despite the fact that this ratio has some caveats, P by E is the most popular ratio in the world of stock investing. P by E ratio is simply the current price of stock divided by the 12 months trailing earnings, although analysts sometimes use 12 months of forecasted earnings as well. Growth investors would like growth in earnings regardless of the direction of the price of stock. Conversely, the value investors want to see declining P by E ratios in order to hunt for the undervalued gems. Value investors typically go after companies whose earning growth rate is higher than the P by E ratio. The second metric admired by the value investors is the existence of the current P by E ratio falling below the past 5-year average. Number 6, price to sales P by S. There is general perception that sometimes companies would twist accounting methods in order to manipulate earnings. It is rather difficult to apply such manipulation to the sales number. This metric throws light on how much money you are willing to pay for the sales generated by the company. For growth companies, this number should continue to be smaller. However, growth investors will not care much about this ratio as compared to value investors. The value investors would like to see this ratio lower. Number 7, price to book ratio P by B. The book value means how much a company is worth if it was liquidated today. The price to book ratio is a simple comparison of stock's price to net asset value of the company. The main caveat here is that the metric focuses on tangible assets of the company. Investment research has revealed that intangibles also play a significant role in the value creation for the shareholders. It is for this reason that P by B ratio is not a comprehensive metric. Number 8, value creation and growth metrics. Most stock analysts typically focus on EPS metric for the past 5 years. Although earnings and sales are like lifeblood of a company, yet basing stock investing decisions on earnings standalone can be misleading. More specifically, the analyst should undertake more detailed analysis of the following 3 key areas that determine the earning sales of the company eventually. A, the quality of revenue earned by the company and transparency, compliance standards of revenue recognition. What are the growth prospects of the company? B, the profit margin or quality of earnings. What is the strategy of a company to optimize costs and increase return on investments? Of course, management plays a critical role to enhance size and quality of earnings. And finally, C, what is the position of cash flows? It is important to purchase stocks of companies with positive cash flows.